30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, Intel struggles while Nvidia gets a boost as China tells firms to prepare their H200 chip orders.
And it's Trump versus Dimon. The president sues JPMorgan and its CEO for at least $5 billion over alleged debanking.
And the U.S. government urges grid operators to tap backup power as record winter storms threaten blackouts nationwide.
I think that's like the most important story today. I know a lot of other stuff. For us. It's going to hit most of the U.S. too. We're going to have more on that in a moment. But there are some stocks moving in the pre-market. Capital One being one of them. Down 3.4%. It delivered disappointing fourth quarter earnings. It had higher than expected costs. The company also said it agreed to acquire fintech company Brex for over $5 billion. So those shares sinking in the pre-market, Matt.
All right. Probably the most important story for the markets is that China is going to allow firms to buy Nvidia chips. As a result, Nvidia shares are up in the pre-market. You see the gain only a little more than 1%, but this has definitely been rumored for a while. So buy the rumor, sell the news, maybe in effect here. AMD also rising about 2.5%. And then Intel falling after the chip maker gave a lackluster forecast and warned of a manufacturing problems and a multi-year process to turn this company around. Dani.
Let's start with that Nvidia news you were hitting on, Matt. Frank Lee of HSBC weighed in on China's impact to Nvidia sales.
It's too difficult to take a stance on the China situation because of the uncertainties around the geopolitical side, around the trade side. So we have generally not included the upside in China into our revenue numbers. And we've been saying that, Nvidia, while China is nice to have, it doesn't contribute as much to the overall growth as people think. I think Nvidia will have a very strong year with or without China.
Let's bring in Bloomberg Tech's Caroline Hyde on this. And Caroline, the reporting had been a lot of back and forth, whether China would allow H200 sales or not. I guess this is a move in the direction of, yes, they will allow it for some companies, maybe.
Incremental steps. And we know that there isn't enough being produced domestically by China to satisfy Alibaba, Tencent. We also know that they're all in on AI prowess on the large language model front. They need more sophisticated chips. So no wonder we knew that Alibaba, Tencent had probably put in 200,000 orders each is what they kind of want allotted to them of H200s. Now we understand Beijing has allowed them to take the next step in preparation, whatever that step might be. They haven't formally said, go for it, guys, everyone bring it in. They're still aware of military. They're still aware of course, Chinese strategic companies using them. But more broadly, they look like they're ironing out the approval process to allow them to start bringing them into China. But remember, these aren't cutting-edge Blackwells. These are H200s. These aren't the best of the best.
And, well, as a result, this is a $30 billion, potentially $30 billion order pool and not a $50 billion market, as we've heard from Jensen Huang. I want to ask about Intel because Lip-Bu-Tan warning shareholders, and it sounds really bad when you think of a 14% decline in the pre-market or a 12% decline in the pre-market, but the shares are up 50% year to date, and we've only had like 14 trading days, right? So it's not enough to wipe out what we've seen in this month.
I mean, Intel doesn't usually have these sorts of months. It's the best month since January of 2021. Significant exuberance that this was the company that was going to be able to satisfy CPU demand that we're suddenly seeing because we need them in the servers, we need them in the AI play as well. The fact that AI PCs are becoming more of the thing. Panther Lake was their new innovation that everyone wanted to get their hands on. The problem is manufacturing. What does this mean about their fab side of the business? Their yields are bad. They're not able to print enough chips, enough silicon that the market wants. Everyone thought that the demand was there, but actually it's a supply side issue right now. What does that mean in terms of winning more customers than just themselves if they're becoming a key fab player in the US? I think longer term, he's admitting that this is really bad and not where he wants it to be. How quickly is he going to turn it around?
Caroline, thank you so much for joining us on those two stories. That's Bloomberg Tech's Caroline Hyde. Turning now to Wall Street versus Washington. President Trump is suing JPMorgan and its CEO over alleged debanking, while Bank of America and Citi consider new cards with a 10% rate to satisfy Trump's call to cap credit card rates. Joining us now is Herman Chan, bank analyst for Bloomberg Intelligence. Herman, you probably didn't see yourself also becoming a political analyst, but here we are. Here we are. offering a 10% rate cap. It's obviously not the worst scenario, considering the worst scenario would be a blanket 10% cap on all credit cards. Right. What might this business actually look like to have banks start to offer some of these trump cards?
Right. So it'll be interesting to see how it unfolds. And I'll admit that things are fluid right now. Our colleagues at Bloomberg News have talked about a new credit card offering by Citi and Bank of America with a 10% rate cap. In our view, that's probably limited to your prime, super prime customers.
It's so meaningless without knowing the terms, isn't it? I mean,
exactly.
You could say we're going to offer a 0% card, but it's only for, 2026 and only for people who earn more than $1 billion a year. Like, who cares?
Exactly.
Unless you know the details, it doesn't matter.
Right. And banks are already offering a 0% APR introductory rate anyway. So does it really change things? At this point, it doesn't look like it does.
How should we just be thinking about regulatory risk, and more specifically, regulatory risk is even the wrong word, just the risk that the president calls out specific banking CEOs and does lawsuits or tries to take action, versus a more accommodative sort of environment for the banks to allow for things like consolidation.
Right.
Which wins out?
We've got a little bit of both for the banks that are operating in this sort of environment. The big banks seem to have the brunt of the political risk given the credit card issue. We've seen Trump, limit buybacks for other industries or want to limit buybacks for other industries. So that is the overarching risk for the banks. I would venture that the regional banks that aren't in the limelight probably are operating at a better standing because they can do the M&A but don't have that regulatory risk that you just mentioned.
The Chiron here, Trump sues JPMorgan for $5 billion and I think more importantly, Jamie Dimon, right? So this is the kind of thing that focuses minds, certainly is what the White House is thinking. And I don't know why the copy always says alleged debanking. Like debanking, either it happened or it didn't. Right? The point is why it happened, if so. How should we view this case?
Right. So my Bloomberg Intelligence colleague Elliot Stein has said there's a 70% chance that JPMorgan could win this potential lawsuit because banks have very big leeway to close customer accounts. And I harken back to why this happened, because during the Biden administration, there was a much stronger push for reputation risk with the regulators. And so that trickled down to the banks and how they operated and how they potentially closed accounts. So it was part of the regulatory fabric at that time, which now has been removed.
At least Jamie Dimon's going to be paid more. They just raised his pay increase, I think, to like 40.
But only $42 million. And if he's on the hook for $5 billion, that's probably more than he actually has in assets.
I would assume the $5 billion, though, is not just him personally, right? Like
no,
that's him plus
split, and probably the bank takes some liability for that, right?
And there's blanket insurance on executives for these sorts of things as well.
All right, Herman Chan of Bloomberg Intelligence will continue to be talking to you, as well as Elliot Stein and Jennifer Rhee of Bloomberg Intelligence on this suit. Now, record-breaking cold is fueling the season's biggest winter storm, and forecasters warn it will hammer 33 states across nearly 2,000 miles this weekend, impacting more than 180 million Americans. New York City is in the crosshairs for up to 16 inches of snow, and Texas braces for what could be days of dangerous ice and cold. For more, let's bring in Julie Fine, Bloomberg's Texas bureau chief. Julie, I guess you're a meteorologist now. What are you experiencing in Texas, and what are you bracing for?
Meteorologically, I might fall a little bit short, but I will tell you right now, it's still warm. It's fine out now. It's just going to start raining. It starts to get cold, below, under freezing. Later this evening, that's where the problems come in, because it's not going to warm up until Monday. And basically, you wait on the sun here. So the roads are being pre-treated, but unlike where you are, Matt, it's not like we have tons of plows. We have a lot of equipment for this. So you have to wait to see what happens in the next few days. And of course, people are concerned about the power grid, especially if you lived here in 2021, as I did. So there are a lot of questions about that tonight and whether it will hold. I do want to point out, there has not been a major problem with the grid since 2021. There have been some changes. Those could be tested right now. The governor already out speaking about this, about preparation. So it's definitely a concerning time here. You go to the grocery store here, Matt, The shelves are empty. People are taking this seriously because they understand if those roads are slick, you're not leaving the house.
Julie, how much does it change things? Not only do you have the energy infrastructure in Texas, but in the state and really in lots of parts of the U.S., you also now have data centers. You're getting increasing more crucial American infrastructure popping up. How well protected is the infrastructure of Texas, be it the grid, be it data centers, from this kind of weather disruption?
It's interesting that you asked that about data centers, because after legislation, many data centers have agreed in situations like this to either provide their own power or not take anything from the grid here. There is some protection. Our grid certainly is in better shape than it was in 2021. I think a lot of other states, whether they're an independent power grid or they rely on other states, have worked to make sure those things don't happen. But again, when you are in a southern state, you are dealing with different issues than you're dealing with in the north that are used to getting this type of precipitation and this type of snow.
Julie, we hope you stay safe there in Texas, as we hope for all of our viewers this weekend. Julie Fine, Bloomberg's Texas Bureau Chief. A quick check on futures this morning, because we're heading for a day of losses, snapping 2 days of gains. But all this together means that we will see another week of losses. Matt, that counts for 2 back-to-back losses, and that's the first time we will get that since June.
Yeah, I mean, right now, S&P futures at 69.29 indicate a slightly positive cash open, right? Because we closed at 69.13. There's a little premium in there, but it shouldn't be that bad. And who knows what happens throughout the day?
Who knows?
Right?
It's a mystery. It's going to be like a push and pull between whether Intel or Nvidia wins everything.
Exactly. And Nvidia is a far larger company, so I expect Jensen Huang to win that battle. Let's take a look at some of the other movers on our radar. Shares of Booz Allen are rising in pre-market trading after the defense contractor boosted its full-year profit outlook. The defense business is good.
Meanwhile, CSX providing some guidance for 2026. They forecast low single-digit revenue growth.
And SLB, Schlumberger, reporting better than expected earnings and raising its dividend. The CEO says the worst may be behind the global oil market.
Coming up, offsetting glut concerns, dollar weakness has oil rising despite worries about higher supplies. This is Bloomberg Open Interest.
Let's get now to high interest. Look what's making headlines around the world beyond the snow. Amazon is preparing to cut thousands more corporate jobs, with layoffs expected to begin as early as next week. The move follows 14,000 cuts announced months ago and is part of an ongoing effort to trim management layers. Warehouse workers will not be affected. China is expanding its review of Meta's $2 billion purchase of the AI startup Manus. Probing currency flows, taxes, and national security risks, regulators are concerned sensitive Chinese AI technology or data may have transferred to the U.S., raising the possibility the deal could be altered or unwound. And oil prices are moving higher as tensions with Iran flare again. President Trump renewed warnings to Tehran and ordered U.S. warships towards the Middle East, raising fears of supply disruptions from one of OPEC's top producers. The risk premium is growing just as outages in Kazakhstan tighten global crude supplies. Joining us now is Mike McGlone, Senior Commodity Strategist for Bloomberg Intelligence. And Mike, this, I think, dovetails well with the Schlumberger story that maybe the worst of, I guess, the supply glut or the demand drop is behind us. How does the oil market look set up to you?
I doubt that, Matt. That would be nice, but typically oil has to find a low-price cure. For the last 20 years, for 3 times, that's been around $40 a barrel. And the situation now, I think, is more significant as far as glut than ever. I mean, last year's high was 80, the low was 55. We're bouncing on that 55 level. 55 is basically the break-even cost in this production. But you saw what happened recently. The whole world order has shifted over to the Western Hemisphere now being the price maker. And we have a motivated president for lower energy prices, and we saw what he's willing to do. In addition, we have declining demand from China, increasing supply from all the Western Hemisphere. It's a bear market, and we're supposed to get decent bounces in bear markets. So I look at it this way. I'll end with this. Before COVID, basically WTI was stuck between $42 and $65 a barrel. I think we're back in that cage. I think any rallies near 65 will see responsive selling as producers use that to bring on more supply.
Hey, Mike, I would love to get your take as so much of the U.S. is bracing for really cold weather. It's easing today, but natural gas had a serious run up in the first 3 days of the week. In past instances of this, how should we look at electricity prices with seriously disruptive weather?
Well, one thing about natural gas, Dani, the price you see on the screen now, just above $5. Next week at this time, we're switching to the March contract, and right now that's $3.60. So we're probably going to go back to that level. The key lesson about natural gas is every time it pops near 5 for the last almost 20 years, the elasticity kicks in. U.S. producers bring on much more supply, and the price goes down. So electricity is part of the demand, but it's really heating degree days in the winter, and you're seeing that cold spell. If we get a second colder than normal winter in a row, what does that mean for global warming? So I'm just skeptical about natural gas staying above 5. There would be a paradigm shift, and it also pushes against the president's policy of bringing on more supply. So I doubt it'll happen. The key thing, though, when you say electricity, the first thing I think of in commodities is copper and silver, and they've already had major rallies based on that, and they're probably near peak levels.
Hey, I got to ask you about, Mike, the metals here. New records for silver, for platinum. Gold at one point, I think, pushed above and has come back down, but still very close to $5,000. I was at an Aon symposium in Miami, in Biscayne Bay. Very nice, by the way. Talking with Sadiq Waba, who said he's diversifying. And not only across assets and regions, but into metals as well. Is that what's driving this price up? Is the lack of risk premia elsewhere in the market pushing investors to diversify into gold and silver?
The number one thing, I think, Matt, to think about what's pushing up the price of gold is every time Mr. Trump opens his mouth. The gold market absolutely loves Mr. Trump. But I like to think what you just said sounds very similar to what I remember hearing and feeling and seeing in cryptos last year. So I think this is a selling when they're yelling market now. If you look at silver, for example, maybe it's going to trade $100 an ounce today, but it's the lowest price ever versus crude oil. I'm not bullish crude oil, but it's just so silly expensive now. Even gold around $5,000 an ounce, I get it. Everybody points to the fundamentals, the things we pointed out years ago. But now that we've rallied this far, don't underestimate the elasticity of a supply-demand curve. When prices shift, it shifts the supply-demand balances. I think what we're going to do this year is put in highs in gold and silver that might last for decades if history is a guide.
Biscayne Bay is so nice, Mike.
Yeah, it is.
I mean, I got to Miami and the Uber driver was like, I'm sorry it's so cold. It was 70 degrees.
Yeah.
70 degrees.
Well, we're suffering through that, but we'll do okay.
Mike McGlone there, Bloomberg Intelligence, out of Miami. In our next hour, don't miss, we could have spoken to Mike, by the way, about the weather, as well as Julie Fine. Don't miss our interview with Critical Metals CEO Tony Sage. We'll be talking to him about commodities, as well as Greenland, where it's also cold. Coming up, Kristen Bitterly of Citi Wealth as traders gear up for a big week of earnings. This is Bloomberg Open Interest.
Earnings are going to be great. You know, the economy is going to be great, but you're going to see significant multiple compression. And this is actually right in line with history. If you look back over time and you look at years with above trend earnings growth and above trend GDP growth, those have actually been the worst years for equities based on average return. So it's not necessarily, the market doesn't react to what's happening, it anticipates what's going to happen. And I think that's where we are now, is a market that's already anticipated the good stuff that's about to happen.
That was Savita Subramanian of Bank of America speaking with me earlier on Bloomberg Surveillance. Let's bring in Kristen Bitterly of Citi Wealth. Kristen, great to see you this morning.
Great to see you too.
I think that's an anxiety that's playing out on a lot of people's mind. Growth looks good, earnings look good, but valuations are so rich. How much more room does this equity market have to run?
I think it has more room, but it's going to be with volatility. And I think when people hear the term volatility, their knee-jerk reaction is, I should exit. And really what it means is you should upgrade. You should make sure that your portfolio is prepared for this volatility. So exactly what we just heard, if we have earnings growth, we're coming into this year, we have earnings growth 12 to 14%. That is very robust earnings growth. And then you look at the companies that are driving this. That's the other question. What about the concentration in the market and the Elite 8? It's yes, they're 40% of the index, 38% of the index, but they're also driving 30% of the earnings. They're anticipated to drive 40% plus of the earnings growth. and they're 40% of the free cash flow generation. So I think there's so much noise in the market. There's so much noise in news flow, but I think volatility creates opportunities, and it's certainly at the beginning of the year is a good time to rebalance.
We have seen a lot of that happening. I mean, the equal weight is outperforming the S&P 500 price-weighted index. The small caps, the Russell 2000 has outperformed the S&P massively. And I wonder if the clients that you talk to are also participating in that broadening out. Are they saying, like, look, we have invested in the Great Eight or whatever you want to call them, but
Elite
we're buying Elite Eight is also, but it doesn't rhyme, so no thank you.
Okay, Great Eight, we'll do it.
It is.
But are they buying the rest, the S&P 492?
Yeah, so what I would say is, like, within our portfolios, we are extremely diversified. So having this home bias, U.S. excellence is definitely represented within our portfolios. We have exposure to all parts of the market, but this trade where you're actually downgrading in quality, I would be a little bit concerned about that, because if you're trying to say, how am I going to insulate and protect my portfolio going forward, you don't have to reach too far. Like, when you look at this broadening out trade, you saw it last year in financials, you saw it in healthcare start to take place. So yes, you saw small caps that were on a tear, but you don't necessarily have to participate in lower quality to experience strong returns.
Hey, Kristen, you're going to stick around with us for the opening bell. That's Kristen Bitterly. And a quick check on futures, just minutes away from the open of cash trading. We are looking at a negative future session, down about 0.2%. NASDAQ underperforms after that miss from Intel, and the Russell 2000 outperformance seems to take a break after 14 straight days of outperforming the S&P. Your opening bell coming up next. This is Bloomberg.
Happy Friday. We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. Futures are down just a little bit. We're looking at 69.35 on the S&P, so about 0.1%. That's about 22 points higher than the close yesterday. So maybe we open in the green here. A little bit of a premium, obviously, on futures. NASDAQ futures down 0.2. Russell down 0.3, but Russell has really been outperforming. We have Rhythm Capital ringing the opening bell at the New York Stock Exchange. There's the CEO, Michael Nuremberg, with his crew. I think they're celebrating a couple of $100 million acquisitions, or a couple acquisitions worth $100 million. More importantly, equipment share down at the NASDAQ market site, not only because these guys are wearing T-shirts with blazers, and I'm glad somebody's bringing that back, but also because they have a mascot there. And I think more companies should have big, goofy mascots.
I agree. I think it's good that the mascot isn't blocking people, but I'm also kind of upset you can, like, barely see it.
Here he is.
In a tiny corner.
And we have the CEO coming on with us. I don't know if he's going to bring the mascot.
To be clear, that mascot is not the CEO.
They are IPOing today, and so we'll talk about that IPO, how they made that decision, how their business is doing.
I am looking forward to that conversation. In the meantime, Matt, I am also looking at shares of Capital One getting hurt today, down more than 4%, or now less than 4%. It's waffling around about 4%. It had its fourth quarter earnings report. It had higher than expected costs. Adding to those costs, the company also said it agreed to acquire fintech company Brex for over $5 billion, and it just shows how things are priced to perfection, and if you don't show up this earnings season, Matt, you get hit hard.
All right, shares of Nvidia and AMD are rising. Sources say Chinese officials have told the country's largest tech firms they can prepare their orders for Nvidia's H200 AI chips. At the same time, Intel shares are falling after the chip maker gave a lackluster forecast and warned of manufacturing problems. Lip Bhutan, the CEO, said this is a turnaround that is a years-long process. So there's the tug of war that we're watching in terms of the big tech companies. Obviously, Intel, not nearly as big as either AMD, and neither one, both together, are exponentially smaller than Nvidia. However, we do have very little change in the market today. The S&P 500 at 69.06 right now in the cash trade. Let's bring back in Kristen Bitterly of Citi Wealth, because Kristen, 6,900 is still, pretty punchy. We've had an amazing 3-year run here. I think about 80% compounded return. When you go out and talk to clients who someone brought up the term headline roulette today, right? I mean, you never know what's going to come out of the White House. We're running extreme deficits. We're now paying a ton of interest on that. And yet there's no risk premia at all. Wherever you look, are your clients worried, or are they just saying, like, we're going to close our eyes and buy?
So the good news is our clients are long-term capital allocators. So generally, they're not in and out of the markets trying to do the trade of the day. They're trying to build their wealth, preserve their wealth, and they're thinking about how does this actually behave in the context of a broader portfolio. So I think the key risk is we're going to say, what are the risks that could derail the rally that we're seeing? Something that interrupts the AI trade. So it could be something like another DeepSeek. It could be something in terms of really honing in on all of the CapEx spending and saying, are we going to see the return on that investment? The second is the Fed. There's a lot that even though we expect a pause next week and it could be hawkish in terms of the commentary, people are still expecting interest rate cuts this year. And then the last piece is exactly what you mentioned, kind of geopolitics, IEEPA, tariffs. I kind of put them all together. And there is where you need to say, what have I done within my portfolio to insulate and really build a resilient portfolio so I can confidently navigate this and not make rash decisions?
Have people done that, or do you kind of have to hold their hand and be like, hey, you're too all in on risk right now?
So I would say that's our job, right? As advisors, we're trying to help people in terms of understanding how they behave psychologically in these markets. Just like I said, volatility does not mean you're all in or all out. Volatility means you should take a look at the quality of your portfolio and upgrade. So what are some of the things that we've done in our portfolios? We're cautious on duration. So like when you look at the duration in our portfolios, we're not stretching in terms of duration because we realize there could be inflation risk. There could be a lot of volatility, just like we've seen in terms of over the past couple of weeks in the 10-year. Gold is another area that I know that's a very popular trade, but it's also an area that insulates your portfolio when you're thinking about what's the volatility of the dollar, what would be something not correlated to broad-based equities.
Of course. So, I mean, because they're not buying, like the VIX is still trading at 16 and the MOVE index is down. So when I look at where people are hedging, I guess they could be putting on options like Julian Emanuel recommends. But to me, it seems clear that so many, I don't know about your clients, but so many investors, retail and institutional, obviously central banks as well, are buying gold, are buying silver, are diversifying into...
Metals and mining were like the best industry last year, right?
After memory chips, right? So are they doing that as well? Are they still buying gold at $5,000 an ounce?
Still buying gold and maintaining positions, but again, it goes back to as a portfolio hedge. So exactly what you mentioned in terms of if the VIX is muted, volatility is relatively muted within equity markets, that's an opportunity where you could go in and buy some protection. That's how we view. And could we see continued support for gold? Absolutely, in terms of central bank buying, the diversification. Even when you look at the broad-based commodities plays that we're seeing, there's definitely favoritism towards the metals trade versus the traditional energy trade. And you're seeing that play out not just in gold and silver, but also areas like copper.
Well, one of the remarkable things, and Matt, you were kind of hinting at this, that retail traders have become such a force in gold, but also in overall stocks. I've seen a lot of data out. JPMorgan had one that this past month of buying is at a record. Jeffrey is laying out that volume of trades being done by retail investors has exceeded that of hedge funds, both long only and some more the high frequency one, but not the highest of frequency because that's a lot of volume. Does that change the contours of the market to have such robust retail participation?
You know, one of the things that I love about this is not just that they're participating, buying the dip, but they're also holding positions as well. And so when we look at, even when I'm going to link this to the K-shaped economy, one of the big impacts that determines what part of the K you're in is, are you experiencing this stock market rally? Do you hold both financial assets as well as something like your primary residence or real estate? It's now like 65% of the United States owns stock market exposure, some type of equity market exposure, which is markedly different than other regions. And we can attribute that to the low cost of accessing it. But I think this concept of not just tactically trading, but the data that we're seeing around holding positions and participating is actually really positive.
I was going to ask if they're, we're 3 years into a bull market, and they typically, I guess it depends how you measure, but typically measure 5.5 years. On average, of course, it can be, history doesn't have to repeat itself, but are your clients locked in for the longer term, do you think? 26, 27?
I think, again, it goes back to this concept of we don't market time, we're not all in, we're not all out. Are there changes within our portfolios that we look, and we're looking constantly. Our CIO office and our portfolio allocating team, they're looking at opportunities to make sure that we don't have concentrations. Another big topic, too, is this sell U.S. trade. Like, does international exposure make sense? From our standpoint, it does. It certainly does. But that's also not everything is created equal either. Because if you look at a market like Europe last year, did great, but that was largely driven by currency as well as multiple expansion. Not really fundamental earnings was driving that.
Right, and catch up. We've been outperforming for like 20 years, so they scored a few points.
But it's a very value-driven market.
Yeah.
It's a very cyclical-driven market. So if we're going to go international, we're going to go into China, where there's a clear opportunity in terms of the themes that we want to invest in, the valuation, as opposed to just saying, let's diversify away from the U.S. and buy all international.
It's a great point, but also because EM has had a really good start to the year. And I wonder, and we were kind of talking about this before with small caps, how much about this year, if we are broadening out, is about everything doing well, but some of the laggards just doing exceptionally well, or if you continue to see what we are seeing now, and that is the Mag 7 actually falling, actually being a losing trade.
Yeah, well, it's the first couple weeks of the year is hard to say that we're going to extrapolate out for the entirety. I think you have to be fundamentally based and say that earnings is really what matters here. And I would rather be long free cash flow compounders as opposed to going down in quality. It doesn't mean that you can't, and it doesn't mean we're not participating. Of course, we have exposure in our portfolios. These are decisions as to where you go overweight or underweight.
All right. It's been so wonderful to have you on, Kristen. Thank you so much for joining. I hope you're staying safe in this very cold weekend.
We will do our best, even though I'm not prepared, but I will be.
It's okay. You got like 2 days.
Join the club.
2 days maybe. Yeah. Actually, that's a memo for everyone. 2 days to get your life together. Kristen, thank you so much. Citi Wealth's Kristen Bitterly. I want to get a check on this equity market about 10 minutes into your trading day. Here's where we stand. We are at a slightly weaker session, down 0.2%. Financials at the bottom of the pile. We were showing you Capital One shares falling. They had earnings that disappointed. Kind of the worst part of it was the fact that costs just keep piling up. They also announced an acquisition, so that not giving anyone any comfort. So financials down about 0.75%. Followed closely by information technology. Disappointing earnings from Intel. Matt pointed out that, yes, they've run up not just 50% year to date, but 150% in the past year. So what's one day off, but it is weighing down overall tech. The only sectors doing better, 3 of them, energy, communication services, and consumer staples. Energy, you are looking at oil. Those prices are moving higher for NYMEX crude, for Brent, and you have things like nat gas also getting a higher day considering the storm coming. There's concerns about that. But overall, Matt, again, it is a weaker day, and we are headed for another weekly loss, the second one in a row.
All right, so we'll continue to watch those groups for you, as well as the swinging indexes. Coming up, shutdown potentially averted. The House moves a $1.2 trillion funding deal to the Senate. What it means next with the chair of the House Ways and Means Committee. This is Bloomberg Open Interest. Congress is getting closer to fully funding the government. The House passed its final 6 spending bills, more than $1.2 trillion worth, sending the package to the Senate ahead of the January 30th deadline. The deal locks in fiscal 2026 funding and adds guardrails against Trump administration funding shifts. Senate action is expected next week. Let's bring in Jason Smith, House Ways and Means Committee Chairman, the top tax official in Congress, to talk about a range of things, including what comes next. But first, Mr. Chairman, let me ask about this passage. Who's responsible? Have you saved the day? Are we going to avert the fears of a government shutdown?
Well, I think Republicans and Democrats definitely learned their lesson from a 43-day-long government shutdown last October. And so everyone was committed to work together in a bipartisan approach to pass these funding bills so that we're not left like what we were back in October. So I am thankful that, in fact, my counterparts on the other side of the aisle, they came together. We all worked together. We're going to get the job done.
Representative, the Obamacare premium cost that led to the longest shutdown in American history, that wasn't folded in to the appropriation bill that just passed. When do you expect the Senate to take up that bill and take up that issue?
Well, the Senate's already voted that bill down. In fact, they actually did a vote before the House ever did a vote. And that leads to what we did yesterday. We had a hearing in the Ways and Means Committee yesterday where I brought in the 5 largest health care empires in the world to figure out ways to lower the cost of health care for every single American. Unfortunately, the Democrats, their solution was just to throw more money at the problem, which is what you're referring to, is those subsidies. Those subsidies only affect 7% of the population. Premiums for 100% of Americans are going up. We need to look at lowering healthcare costs for every single one of them.
So what should we do? Because, as long as so many millions of people don't have health care in this country, they're going to be going to emergency rooms. Obviously, they're going to get some kind of treatment, and that's going to drive up the premiums for you, for me, for Dani, and everyone who does have health care. Why can't we find a solution to this issue that every other first world country on the planet has already solved?
Well, if you just look at so many aspects of healthcare, I've been meeting with individuals that give me the prices of a bypass surgery in the United States versus one in the United Kingdom, and it's almost 5 times as much. Why is that the case? Why has our healthcare spending in 2000, $1.3 trillion in America, and 25 years later, this past year, it was $5.4 trillion? Cost is going out of hand. But one thing that was highlighted in yesterday's hearing that is so crucial and so important is that we invited the 5 largest health insurer CEOs to testify, but what we found out is that they are the 5 largest healthcare empires because they're not just insurers. They're also medical providers and they're also pharmacists. The top 3 health insurers have more than 50% of the entire health insurance market, and just 3 of them have more than 80% control of the PBMs.
But
they're
sir, you are
negotiating with the
Congress.
PMs and they own them.
Mr. Chairman, doesn't the fault lie not with the CEOs of health insurance companies, but with Congress? Why don't we have a single payer system or some sort of hybrid model like in the UK or in Germany or other places where everyone is insured, where every citizen of those countries, those rich countries, and we are the richest among them, have health care?
No one in the United States is denied health care, nor will they ever be denied health care. That is a simple law that's right here. What we have an issue with is there's so many entities within healthcare that are profiting off their own special carve out. We have to look at the integration of all these companies. We have to look at transparency. We have to look at competition, and we have to look at economic freedom when it comes to healthcare decisions.
Chairman, I have to say, just listening to you talk feels like a very different tone, not just from you, but this administration too, on how it's approaching companies. Honestly, hearing you talk, it feels more almost like a populist statement to saying that these companies need to be held accountable. Is this a different Republican Party that wants more of a say in how corporates behave?
Let me tell you, the Republican Party is the party of the working class. We're the party of the people. We're making sure that patients are before profits, and that is the whole purpose. Let me tell you, I have no problem as chairman of the Ways and Means Committee to hold any corporation, any healthcare empire, their feet to the fire whenever they abuse the system and when they take advantage of American taxpayers.
Speaking of taxpayers, I saw headlines yesterday that we're expecting refunds to climb 15 to 20% from last year. I wonder, what is your take on that, as the one big beautiful bill looks to return a lot more money to taxpayers? And how is the IRS functioning right now? What kind of delays are we expecting? How understaffed is that important organization?
The IRS is expected to start their tax filing refund processing on time. That's January 26. What we passed in the One Big Beautiful Bill was the largest tax cut in U.S. history. And guess what? The IRS is ready and prepared to implement that. This will be the largest refunds that Americans have ever received. In fact, tax refunds are being increased 26% on average because of the no tax on tips, the no tax on overtime, the tax relief for seniors, expanding and increasing the child tax credit, expanding and increasing the standard deduction, and making sure that tax rates did not go up. These are things that people are experiencing right now. Just in the first pay period of this year, they're already seeing bigger paychecks alone.
Can I ask finally, Mr. Chairman, about, there had been so much criticism from Republicans about the Biden administration dragging its feet on the Epstein files, not making any headway in terms of making them more transparent, exposing those pedophiles. And now it seems like the Republicans in Congress and certainly the administration is the one doing the holding back. We're dragging our feet on releasing these files. We're redacting everything in them. Why is it so concerning to the Republican Party and this administration that the Epstein files be withheld?
That is laughable. The Trump administration has been the most transparent of any president.
Why haven't they released the files?
This past week, in a bipartisan fashion, the oversight team held Bill Clinton and Hillary Clinton.
Why haven't they released the files, Mr. Chairman? Why are they late? Why is the Department of Justice late in releasing the files?
They have released more documents than any entity or any president. But the fact that in a bipartisan approach, Bill Clinton and Hillary Clinton was held in contempt in the last week of Congress because of their involvement in Epstein. That is what people need to be looking at.
All right. Well, we look forward to the full release of those files, hopefully with far fewer redactions. Jason Smith, House Ways and Means Committee Chairman, thank you very much for joining us. Turning back to what's going on here in the markets, we are looking at a swing back and forth between gains and losses on the S&P 500, but still at over 6,900 right now on the S&P. In terms of the Sell America trade that is talked about so much, many Europeans maybe would like to do that, but ETFs show that doing it is much harder than just saying it. And joining us now is James Seyfert of Bloomberg Intelligence. And James, it looks nearly impossible from reading your research for foreign or overseas investors to actually pull the trigger on what a Sell America trade could or should look like.
Yeah, I mean, it's more, it ends up being a little bit hyperbolic when they say that. When we look at the numbers in 2025, they did buy a lot less U.S. stocks and U.S. assets, at least European ETF investors, than they have in any year prior. But that doesn't matter because they were buying a lot of global stocks, which has, if you're buying a global index portfolio, depending on what it is, it could be anywhere from 40 to 60% U.S. assets anyway. So yeah, that if you're looking at this, essentially, it's a lot of, talking about selling it, but it's hard to actually fully divest from actually investing in these things. So again, the European ETF market isn't going to be symbolic of all European ETFs, but it's probably somewhat representative. It's a lot harder to completely divest. So it's more about we're not investing as much in the US as we have been, but we still have our exposure and we're still actually buying a little bit more.
James, how much of what we're seeing right now, though, isn't necessarily divestment, but is just after a year where Europe outperformed and expectations that the rest of the world could very well outperform again versus the US?
Yeah, I mean, obviously, part of it is that international stocks outperformed in 2025, and there are plenty of, people out there saying that they expect it to continue into 2026. So part of it could just be, it's not as much Sell America. It's just like, oh, I'm going to ride the hot thing right now, and that has been international stocks. I mean, no matter how you slice it, if you look at the top end of the U.S. equity market, you're looking at multiples and valuations, it's very easy to make the argument that it's very expensive to invest in U.S. stocks. So yeah, when we look at this, it's pretty hard to see any semblance of true selling. Like obviously, we had the Danish pension fund that's dumping some treasuries, but it's in the grand scheme of things, it's very small in any sort of full selling context. But for the most part, they're still heavily invested in U.S. assets across fixed income and equities.
Well, and so much has been made, James, of last year's outperformance in overseas markets. But if you look at a longer view, the U.S. has far outperformed European assets and EM. How does that look from through an ETF lens?
Yeah, I mean, no matter how you slice it, if you look at things, going back to the beginning of 2025, it's pretty comparable. I mean, yes, the international markets beat the U.S., but it wasn't by like a massive margin. The U.S. market still performed, 18% over the year. So it's not like the U.S. went down and European or international stocks went up. And then, like as you said, you extend that out a couple of decades, and it's not even comparable to talk about this. We're just at a blip now of showing international outperformance. And ironically, we're seeing a little bit of, the non-Mag 7, the smaller stocks in the U.S. actually showing the same sort of thing over the last 2 months.
James, thanks so much. James Safert there of our all-star ETF team at Bloomberg Intelligence. Coming up in the next hour, Amy Wu Silverman of RBC on what she calls violent rotations underneath the market. Partners Group CEO David Layton and his company, their AUM rises by more than 20%. Plus, Critical Metals CEO Tony Sage, they get rare earths out of Greenland. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. Stocks going a whole lot of nowhere after 2 weeks of selling and small cap outperformance. All of the volatility taking a breather this morning.
Except for Intel. Those shares are down hard. And Nvidia is getting a bit of a boost as Lip-Bu Tan warns about a years-long turnaround and China tells firms they can buy AI chips from Jensen Huang.
And as this week's geopolitical whiplash comes to a close, only because it's Friday, not that there still isn't geopolitical risk, we're going to speak to the CEO of Critical Metals, a company at the center of speculation around Greenland and mining.
And betting on industrial tech, the CEO of Equipment Share joins us as his company makes its trading debut, and construction workers rush to put up data centers across the country. We have breaking eco data right now. Sorry, I got a little bit excited about the.
I could tell.
The Equipment Share thing. Well, the data center build out is huge, right? And that has probably a lot to do with the stuff that Mike McKee reports on as well, our international economics and policy correspondent joining us here on set, because we have some economic data breaking and
economic data that is moving the markets. Check out what's happening with equities right now, because the University of Michigan is reporting we're a whole lot happier than we were yesterday, or when the last time they took their survey. 56.4 up from 54. So a significant increase in sentiment. Current conditions rise to 55.4 from 52.4, and expectations to 57 from 55. So across the whole expectations curve, we see an improvement. And we see an improvement in the inflation outlook. The 1 year now down to 4% from 4.2%, and the 5 to 10 at 3.3, down from 3.4. So some good news there. Just a few minutes ago, the S&P Global U.S. Manufacturing PMI came in at 51.9, up from 51.8. Services also rose by a point, as did the composite. So overall, these sentiment indicators are suggesting that something turned around in the last week or so, and things are looking a little bit better to people in both business and on their own.
There has been notable strength in this economy, especially the recent data that we've gotten. At the end of last year, it was about the effects of shutdowns. There keeps being these ruptures that happen. And I wonder, when you look at what we're expecting this weekend, a storm that's going to hit many parts of the U.S., might hurt power centers in Texas, is going to leave people unable to travel, is going to ground flights. What type of economic impact might that have, Mike?
Aren't you the cheerful one?
Hey, I heard from an AccuWeather meteorologist, and that made me super depressed about this weekend, for what it's worth.
There will be an economic effect. It'll probably be very short-lived, though, because people tend to forget about these things a short time after they happen. The problem with this storm is it's not going to be just a short-time effect if we get a lot of ice around the country, because the temperatures are going to remain cold. Just starting on probably Saturday night from Chicago east every airport is going to be closed. So an impact on business travel and even and tourist travel. We get a little bump in spending. You guys can check out what happens with Home Depot, Lowe's. Everybody's out trying to buy generators, snow shovels. I know Matt's looking for
a blower. I want a blower.
Snow blower.
Yeah.
Good luck. And then we stop spending for a couple days because everybody's going to be stuck at home. So there's going to be an impact on grocery stores as well. And then the real question is, how bad are power outages? If they're widespread because of the ice, and this is such a big storm covering so much of the country, a lot of businesses may have to shut down for a few days or even longer. Remember what happened when we had the floods in Appalachia in North Carolina. The western part of the state was pretty much closed down for
I need to get a generator too.
Yeah.
This could just be a giant reminder of how much consumption we need to do. You know, I need to buy a snowblower. I need to go get a generator. Maybe we'll have a big boost in spending after this storm.
And if anyone is spending on delivery, please tip your delivery service people an insane amount, like as much as you ordered in food or whatever.
He goes to look for generators. We're going to go look for like hot chocolate.
Yeah, and maybe something stronger.
Bloomberg's Michael McKee reporting on the storm here on Bloomberg Open Interest, where we eschew meteorologists. Let's get to a warning from Goldman Sachs. Two of the firm's traders saying the constructive backdrop for stocks is increasingly challenging, citing the length of investor positioning, the return of headline roulette, and a bond market that needs monitoring. Joining us now is Amy Wu Silverman of RBC Capital Markets. She's the head of derivative strategy there. So I thought this is a fascinating note from Goldman Sachs. And then B, I thought, I don't understand enough about how options and derivatives work. So that's why we have you here to explain that. What does this mean that positioning is duration and positioning is too long?
So I think what they're talking about and what we're seeing in the derivatives market as well is there is a little bit of a pickup in angst. One thing we talk about is the steepening of term structure. So short term, you don't see as much of a pickup, maybe a little bubble from the VIX popping over 20, but the longer term buckets of concern are picking up. And on top of that, it's also people are quite invested in this market. And so when people are quite invested in this market and you do get a pothole, there's obviously the left tail version of what happens when that occurs.
I was talking about this earlier on the show, but part of people being really involved and invested in this market has been retail. Retail volumes were already pretty wild last year, but to start this year, they keep setting new records. How does that change the options market and then the overall day-to-day trading of how equities behave?
So, Dani, I can't stress this enough, but we talked about this in the 2026 volatility outlook. This really is a tectonic shift. This is a structural shift. And to answer your question, I think they actually keep stepping in. And one of our predictions was if anything takes out the leg of the retail stool, it's not something scary, it's something shinier. And what I meant by that is with the growth in prediction markets, cryptocurrency, tokenization, what could actually get retail to move on is just more fun toys as opposed to a multi-standard deviation drawdown on the market itself.
By the way, how important is you watch, I would guess, flows and then sort them out? What's institutions doing? What is retail doing? High net worth individuals versus like Robinhood traders. Yes. How do you sort through all of that stuff?
Yeah, so, and it's interesting because I think we often speak about retail in one fell swoop, which is inaccurate because exactly as you said, there is the retail who has gamified to some degree options trading, stock trading. They're on their Robinhood app. They're on their different apps. And then there's traditional retail, which has a financial advisor. Maybe they have, a large amount of money that's going to pass down generationally. To be clear,
then family offices,
yeah. The call exuberance, the act of trading in options is the first bucket. Those more fractional individual investors that are creating a lot of volume. This really started from the meme frenzy. This started years ago, but has continued. When we think about the flows, what's created the support level are the individual investors. And that's continued to come actually actively step back in, which we find incredibly fascinating. The cohort just believes you buy the dip.
And that's so different than what we usually think of when we think of retail. We think, oh, they're flighty. First thing goes wrong, they're all selling. It's a problem for this market. I do want to just linger on what you said before, that it's a new shiny toy that gets them to move out of this market. Does that mean if I'm looking at the rise of prediction markets, I should be worried for equity markets, that you might see some selling that damages the overall index level if all of a sudden prediction markets get even more popular than they are right now?
You know, this is not a very popular thing as a derivative strategist to say, but look, I'll use the example of Venezuela and Maduro. So if you think about how you 10 years ago would bet on that in the derivatives market, maybe you use some proxy for Latin America, maybe use some sort of correlated trade. It wouldn't be perfect. There were no zero-day options. Now there's literally a bet, and the bet is, do we believe that Maduro is taken out by the United States and extradited? And so when you get that level of specificity, yes, I think there is some opportunity to cost versus just the options market itself. You see that in tenors, and you see that in specific trades that are geopolitical.
But by the way, because it's not just retail that's doing prediction markets. I mean, like Cliff Asness was talking to Odd Lots about maybe them looking at prediction markets. Yep. It is more institutional. Are you now having to rethink how you look at prediction markets? I mean, we have the function on the terminal, WSL Predict. It's very highly visited. So clearly,
I just want to call that out. I wanted to call that out. Let's bring up that function quickly, because at the top we have predictions about snow in New York this week.
Of course.
So 26% say 8 to 10 inches, 19% 12 to 14. I just wanted to say, you can type WSL Predict on your terminal and do that.
No, but it also speaks to the investment institutional community want to know this and are curious by it. And I can't say how many research notes I've looked at that have said, well, Predict it says X chance of whatever this is. Do you start to compare that to some of what you're seeing in options? Like for you, is this now a tool too?
It's 100%. It's been a tool for a while because, frankly, since presidential elections, we've been looking at this. What I would say is there's a little bit of an arbitrage going on, because if you think about the regulation that we have in the equity market, the options market, versus what the regulation is in prediction markets, you know, you could argue that it is not the same because there's sort of this arbitrage of information available. I do think if there's going to be more volume, that aspect will change as well, and maybe that normalizes some of your ability to, you know, be very specific. Like, so, for instance, like insiders can't do certain things in the stock market. You know, how does that change over time in the prediction market?
But doesn't that make prediction markets then more accurate, because someone who knows the answer can place a huge bet?
And I think that's the arbitrage that is occurring now from an information perspective. But as regulation normalizes, that might get taken away. I don't know, but I could see that being something that changes when everything kind of gets regulated with the same rules of the road.
This has been so fascinating. We have to do this again on prediction markets. I feel like we could spend the whole hour talking about this. Amy, thank you so much for joining us this morning. Amy Wu Silverman of RBC. Coming up on the show, Partners Group announcing a 21% increase in AUM for 2025. The company's CEO, David Layton, joins us. That's coming up next. Stay with us on Open Interest.
Let's get to high interest now. We'll look at what's making headlines around the world. Oil prices are moving higher as tensions with Iran flare again. President Trump renewed warnings to Tehran and ordered U.S. warships towards the Middle East, raising fears of supply disruptions from one of OPEC's top producers. The risk premium is growing just as outages in Kazakhstan tighten global crude supplies. And a massive winter storm is set to sweep from Texas to the Northeast, threatening days of dangerous travel and widespread power outages. Ice, snow, and extreme cold could impact 170 million people, raising blackout risks as heating demand surges. And French President Emmanuel Macron's reflective blue aviator sunglasses kind of stole the spotlight at Davos, triggering a rush of orders for the frames, priced at about $720 a piece. The glasses, made by Italy's iVision Tech under the Henry Julian brand, drew so much demand that the company's website briefly crashed.
$720? How do,
It's pretty expensive.
It looks cool, but I feel like it's not sending a great signal.
No, I mean, I feel like you could get similar Ray-Bans for far less, but they look pretty quality, I guess.
I don't like that it has me up to very cool looking Macron right now. I feel like I can't really argue with that. I need my shades. Let's put that to the side for the moment and turn to something that I think we're all much more comfortable with, private markets. Partners Group kicking off the year on a high note, rising the most in 6 months after reporting higher assets under management for 2025 and saying it expects even more inflows this year. Joining us now is the company's CEO, David Layton. David, thanks so much for coming in.
Happy to be here.
One of the reasons this is remarkable is because it was supposed to be a really bad year for fundraising, and for a lot of people, it was. So what's different at Partners Group?
Well, the industry is down and still not raising as much capital as it was a few years ago at peak levels. We have the benefit of having a couple of strategies that are highly differentiated. Number one, we are one of the early pioneers in the wealth channel. We raised $9.4 billion this year in private wealth as more and more individual investors are using privates as a key component of their portfolio, and that was helpful. In addition to that, institutional investors, which are a little bit more wary of locking their capital up in long-term limited partnerships, funds that they have a tough time steering their allocations with over the long run, are increasingly using model portfolios and custom solutions that firms like us are building. And our custom account business is now up to $66 billion in size. And those two topics, the private wealth channel and our custom mandates, custom account business, are two of the things that help to drive this result this period.
How much do you think, I was listening to Tom Keene on Bloomberg Surveillance talk about what percentage of private wealth portfolio should include alternatives, or what percentage should be alternatives. What are you seeing?
Yeah, so institutional investors range from 60% in some of the most aggressive usage to 5% in some of the more conservative portfolios. On average, it's about 10.5%
in institutions.
In institutional portfolios. Now, if you talk to the people who run these big private wealth platforms, they're putting targets and objectives out there to have private markets be 5, 6, 7, 8, 10%.
So approaching institutional
of portfolios in the future. And there's a reason for that. It's because many of the companies that would have gone public in years past and been a part of the Russell 2000 or in other indices or accessible to individual investors are no longer accessible. The private markets have become a $15 trillion asset class, and we have become the home to most of the middle market. And so it's not an option anymore. If you want to build a balanced portfolio, you need to have private markets as a part of that. In addition to that, with all of the concentration that we see in public markets today, public markets investors are going to go where the big AI names take them. And people are looking for some more diversification and stability, and that is often found in the private markets as well.
There feels to be a little bit of irony of this rush coming into alternatives from retail, because there's a new source of capital coming in at the same time where we started, that some firms are having a hard time fundraising. When you look at that split right now, how does just the competitive landscape look right now? Are you seeing a lot of various private equity back off, so there's more opportunities, or is it getting more competitive as more cash floods in from retail?
Well, this is a great time to be investing. Valuations are down from about 12 times at peak levels to about 10.5 times today for your average private market business. So it is a less competitive period of time to be purchasing companies in the private markets. And the reason for that is that we used to have thousands and thousands of firms that were raising capital on a consistent basis in the private markets. As those allocations to institutional portfolios expanded from 5% years ago to 10.5% today, you had a tremendous amount of competition that were meeting those institutional investors' needs. Now that the institutional allocations have started to plateau and the growth is coming from wealth, the growth is coming from 401k, it's really only the more sophisticated platforms that can service that channel. That channel is not going to be using limited partnerships, a very investor-friendly tool. They're more demanding. They want more liquidity. They want more options.
Exactly.
And so it's only the larger platforms that are really able to service that segment of the market. So the growth right now is accruing to the diversified platforms.
So I'm wondering, what can you do with your bespoke solutions, right? Can you offer an investor more exposure to alternative assets while at the same time offering a little bit more liquidity than they would get elsewhere.
Exactly. We can custom build a portfolio that meets the needs of those individual investors. In the public markets, you already saw this trend play out over the last number of years. Solutions have been the topic, right? It's gone from products to solutions in the public markets, and you're starting to see that play out in the private markets as well. Just to give you some of the solutions that we built, with private credit being a topic right now, and people are worried about it being overheated, we had some of our clients that wanted their private credit portfolio to lop off the riskier type of loans. And so they put a cap in terms of the debt to earnings level that they would allow in their custom portfolio. We could provide them a portfolio that was custom built for their needs. We had some sovereigns out there that had some different geographical emphasis this year than they have in years past.
Maybe they want less exposure to data centers.
Less exposure to data centers, so we can build them a custom portfolio there. We had a religious institution, a church in Europe, that didn't want to make investments in their community. They thought it would be awkward if they had to enforce on one of their members of their congregation or something like that. And so we did a zip code exclusion for that religious institution to meet the specific needs of their clients. And so you're starting to see more and more of these custom solutions working their way into the institutional side of things. And then the individual investors, they're going evergreen.
Hey, David, only about a minute here, but I just really want to get your thoughts off the back of a Davos, where it's this back and forth to, is the world fracturing more, is it not? Partners Group is so unique in how global you are. A headquarters in Switzerland, in Denver, here in the United States. What do you see as the responsibility of this firm to help corporates, to help the companies that you own right now navigate this moment of real geopolitical angst?
Yeah, this is a complex market. And I think it's going to become more complex over the coming years. And so for our clients, they need more solutions that are built specifically for them. For the companies that we invest into, they need strong leadership that has their hand on the wheel, that can help them navigate around the challenges that are presented. And I think the private markets are the appropriate home for these assets today, where ownership is more consolidated. You have governance that's aligned with the management team in a very systematic way. And I think you're going to see the private market start to play a bigger and bigger role in helping to steer the future of many medium-sized companies as a result of this complex environment that we're in.
David, great having you on the program. Hope we can get you back very soon. David Layton there, the CEO of Partners Group. Still ahead, we speak to the CEO of Critical Metals. Tony Sage joins us as tensions linger over Greenland. Get a check on the markets right now. You're looking at an S&P that has been swinging back and forth between gains and losses. Really little changed, but 69.21 is pretty close to the 69.85 all-time high. The Nasdaq up 0.4% as Nvidia pushes it higher, and the 10-year yield coming down, well, barely moving, but coming down a bit as investors buy those bonds for 23.91. When we come back, we're going to speak to Critical Metals CEO Tony Sage on, well, the importance of his business, but also the tensions in Greenland, where he mines to get rare earth minerals out of the ground. This is Bloomberg Open Interest.
But in terms of cooperation with our resources, we know we have huge potential, and we have said from the beginning, let's have respectful conversations and talk about how we can strengthen the partnership also in terms of our mineral resources.
That was Greenland's prime minister on partnering with the U.S. Denmark's prime minister is now flying to meet with him today to discuss the territory's future, which the U.S. has a large interest in mining there. Joining us now, Tony Sage, CEO and executive chairman of Critical Metals. The company just greenlit the start of construction for a storage and pilot facility in Greenland for its rare earth and critical minerals project. Tony, thank you so much for joining. What a week it's been for everybody, but I think It's fair to say that especially you have been attuned to the news. Just the back and forth in Greenland, whether the U.S. would take it by force, now more of an agreement with military bases and a keen interest in minerals. Does this change anything for critical metals?
Oh, not really. On the ground, we're going 100 miles an hour doing what we can control. We can't control the politics of the situation, but it certainly does affect us. I mean, local people are very, very concerned, and we've been operating in Greenland for 22 years. We've never seen a protest before. So they are very, very concerned. It does affect our staff in Greenland. It does affect the mentality for the uncertainty for them. But for us as a company, we're going, like I said, 100 miles an hour. We're building pre-construction. We're doing our pilot plant, our office, and obviously the labs, which is going to be very crucial in analysing all the materials.
Can you tell us what kind of agreements you've struck for the rights to do this mining? I mean, for how long have you got the rights? How do you split it up in terms of what you get out of the ground with the local economy? How does that look, Tony?
Yeah, look, at the moment, we've got a 30-year, 500,000 tonne per annum license to exploit the natural rare earths. The rare earths that we're going to concentrate on is not the lights, for example, MP materials. We're going to go for the heavies, and we've got 4.7 billion tonne ore body, which in effect would last 1,000 years, but we're only going to do a fraction of that, obviously, at the beginning. So we're going to concentrate on the heavies, which are the terbiums, the hafniums, the galliums, and the dysprosium, the tantalum. So those are the ones that the US government are particularly interested in, because it obviously fuels national defence. You cannot build an F-35 fighter, you can't build a destroyer, nuclear power plants, et cetera, et cetera. So they're the ones that we're going to particularly concentrate on in Greenland.
Tony, this has been an American government that's increasingly getting involved in corporate America, in corporations, especially when it comes to metals and taking stakes. For your more recent projects, have you had conversations with this government about doing just that? Any financial commitments that they're hoping to achieve?
Yeah, look, we've had a very, very good discussion with Exim Bank. We've signed an LOI with the Exim Bank. It's a fantastic deal for us. It's $120 million over 14 years at only 1.9%. Really, if you take into account inflation, it's a negative interest rate. So that's been fantastic for us. We've applied for under the old Act DPA funding. So under the new terminology, it's CHIPS funding. We've applied for that. Hopefully we'll get a fair hearing on that. But we've done some very, very good financial manoeuvring. We've decided to do 50% of the product to the US and 50% to the EU. So 100% of our offtake is now being taken up, which completely de-risks the project. So it's fantastic for us, but fantastic for the EU. The Romanian government is heavily involved. 50% is going to go to them. And we've signed deals with Ucore in the States, Realloys. And we followed MP Materials to Saudi. They've signed a deal with Trump and MBS a few months ago. We followed that lead, and we're building a processing plant in Saudi. But all of the product from the Saudi processing plant will go to the US.
So I was just going to ask, where these minerals that you mine are going to be refined. Are you saying that half will be refined in the U.S. or sort of at the behest of U.S. companies? You know, because the refining question is one that sticks in my mind. It's a really difficult process, so I hear, to refine these things. Maybe dirty and dangerous.
Yeah, it's very difficult.
So who does the refining of the stuff that you get?
Okay, so we partnered with the Romanian government, with their nuclear department. They've reprocessing nuclear rods already in the plant. We're going to build our plant next door. The technology is there for us to do that. We're using the same technology in Saudi Arabia, so that will be set. The 25% of the product that's coming directly to the United States, we're using the Ucore technology. They've got a plant in Louisiana, and we're using the Realloys technology, which is based in Ohio. So that's 25% pure product going to the US for US, but the Saudi 25% we're going to refine there is going to go to the US, the end product, which are the terbiums, the hafniums, the niobiums, the galliums, etc.
And Tony, just to kind of reiterate what we've been saying this whole time, and you've been saying that these minerals are highly important to the U.S., and Trump has emphasized that with not just Arctic security as being part of the framework he says exists for a Greenland deal, but also mineral rights included in that framework. Tony, can you give us kind of the sober view of what wealth there is in Greenland when it comes to minerals, but not just that, but how difficult it is to get it out of the ground?
Look, in a lot of areas of Greenland, as President Trump said, is under ice, under a lot of ice. We're very lucky with our deposits. We're in the southern part of Greenland. It's quite temperate. It only gets to -5 Celsius. It's colder in New York and Chicago at some points, and 15 degrees in summer. So very temperate climate, but there are trillions, literally trillions of dollars of material in Greenland. Other than rare earths, you've got one of the biggest iron ore deposits, you've got uranium. The oil and gas potential is absolutely massive. So Greenland is a treasure trove. Unfortunately, a lot of those minerals and oil and gas aren't allowed to be exploited under the ruling of the Denmark control over Greenland. So you cannot draw for oil and gas, you cannot mine uranium, for example. So the potential for Greenland is fantastic. Unfortunately, the current laws don't let you exploit a lot of the material that they do have.
Tony, great to get you on the program again. Thanks so much for joining us. Tony Sage there of Critical Metals, talking about getting these rare earth minerals, heavy rare earth minerals out of the ground. And it's an incredibly important endeavor, as we have grown to realize over the past few years for manufacturing of high-tech goods. Coming up, rental firm Equipment Share raises more than $747 million in its IPO. The company's CEO joins us next. This is Bloomberg Open Interest.
The investment firms are obligated to find the best returns. And so if you actually look over the last year, there was a $3 trillion increase in equity flows into the United States from foreign investors. So that's been a really interesting phenomenon. But I also would say that we just have to continue to drive those outsized returns within our economy to continue those flows coming in. In terms of companies looking to go public, the U.S. markets are the deepest and most liquid markets. They have the deepest investor bases. People understand these, especially for innovative tech companies.
That was NASDAQ CEO Adena Friedman speaking in Davos. Let's stick with the IPO market and specifically on the NASDAQ. Equipment Share just raised more than $747 million in its IPO on the NASDAQ. The company, which rents and sells equipment and technology to the construction industry, is set to trade under the ticker EQPT. And joining us now is the CEO of the company, Jabbok Schlacks. Thank you so much for joining us.
Well-deserved high five there.
We watched you guys ringing the opening bell, and we thought your mascot was tremendous. But it's a serious business, right? And with serious demand, I imagine, because of the data center build-out boom, how much is that a part of a share of your revenue?
Yeah, it's a great question. The data center boom is a tailwind for all construction. And we really, at the fundamental, when you look at the industry itself, connectivity changes industries. We underestimated what the internet would do to everything we experience as consumers. We underestimated what the mobile phone revolution would do. And that secular shift, we will actually underestimate what AI and the impact it has. We're at the epicenter of AI because you still need to build data centers. You need the energy to power those data centers. So it's a small portion of what we're solving today, but it will be massive for the construction industry. And because T3 and that internet for construction is what the core of what we're doing, we will help unlock that for customers, for the industry, as we grow and we change construction.
Jabbok, it's this moment where one of the big arguments, and I'd love to get your thoughts on this, that because of the demand in construction around data centers, it crowds out other projects, that things get more expensive, and I guess in your case, there's more demand, and that demand increasingly gets hoovered up by AI projects and not about other construction. Is there any degree to which you're seeing that?
So I think it reflects, really for such a time as this, because what we do is bring productivity into the industry. So we actually save the industry money. We make it safer, we make it more efficient, but you also can do more with less. And so you're exactly right. In a time like this, where you do have a huge amount of demand from an AI, from data centers, from power, you do need the core and the foundational elements of technology, because then you just get more done, and you can do that, especially in our industry today.
How much of the money that you raised today is going to be reinvested to grow the business?
So I think we're super excited about being in the IPO market today. We're very, very happy with where we are. But again, this is just the beginning. We started a decade ago with 5 of us. We did about $1 million worth of revenue a decade ago, 2015. Today, trailing 12 months, we did $4.4 billion, and we have 8,000 team members in the company. But the opportunity is $11 trillion. Our industry is an $11 trillion industry, and in many ways, it is still stuck in the 1940s. So that technology, that internet for construction, it's changing how work gets done.
So, Jabbok, how much inflation have you seen? In terms of the equipment that you source for your clients, has the price risen substantially over the past, say, 3 or 4 years?
So we've all been here, specifically in the U.S., and there are always inflationary elements. What's fascinating about our industry, and specifically the rental side of what we're solving with equipment, because you purchase that equipment and it stays in your fleet for 7 to 10 years, it can actually be deflationary, especially when you add technology into it. So it does support when there's uncertainty. That's where you need the best technology. You need the best company. And we're positioned perfectly today for solving that on construction job sites.
Jabbok, can I ask, why even go public? It's a market where there's lots of liquidity when it comes to private capital, be it private equity, private credit. You already had private equity involvement in equipment share. What's the appeal in becoming a public company?
Yeah, I think the size and the scope of the problem, which the opposite side is the opportunity. The opportunity is absolutely massive. Many areas of our industry, and again, this is an $11 trillion industry, is stuck in the 1940s. What McKinsey and others say, and you guys have probably seen your own research reports, we lose $1 to $2 trillion every single year just in basic productivity losses. So we think the scope and the scale of the opportunity really necessitates being in a public market.
I got a question here. I'm going to throw in a question for Paul Sweeney, who's over on Bloomberg Radio with Tom Keene right now. He's obsessed with Landman. And one of the interesting things I thought in that show is that so much equipment just gets lost. People steal it off of job sites. And I saw an interesting note in the Bloomberg story about your company. You use a cloud-based system to track where all of your gear is and how its operational status is looking. So I guess, do you not have problems like that? Do you have technology that, puts you ahead of your competitors in situations like theft?
Yeah, I love the question. One, it's absolutely accurate. The DNA of how we've built this company is different. We don't just rent equipment. We started with connectivity, that internet for construction, and you're connecting 3 things. You're connecting materials, you're connecting equipment, as you pointed out, and you're connecting the people in job sites. So when you unlock that, there are hundreds of things it does for the industry. But at the basic core level is, just like you were saying, you know where your stuff is. You know who's using it. You can make sure it's not stolen. So it changes everything about construction, but at the basic core level, exactly what you're saying, it does solve those problems as well.
Happy to hear you don't have cartel members stealing planes and landing them and crashing them. I have seen Landman. Jabbok, thank you so much. Jabbok Schlacks of Equipment Share. Coming up next week in D.C., Trump's affordability push faces Congress as shutdown odds fade. What actually gets done? We're going to have the details with Nathan Dean. That's coming up next. let's get you set up for your week next week. Hopefully, I mean, anything must be calmer than this week. Maybe not. Monday, we're going to get durable goods data. Tuesday, earnings picks up. We're going to get results from General Motors, American Airlines, and UPS. Plus, the president is set to speak in Iowa. On Wednesday, a Fed decision and a Chair Powell news conference. Plus, results from Tesla, Meta, and Microsoft. On Thursday, it's Apple's turn to report earnings. And then finally on Friday, we're going to get results from Chevron and ExxonMobil.
And every Friday, Bloomberg's Nathan Dean breaks down the key events in Washington, how policy is shaping industries and companies, and the catalysts investors need to watch. He does that for clients, and it's an extremely popular service. So we've started to ask him to come on and do it for us on Bloomberg TV. Nathan, let me first ask you about this bill that's just been passed. We spoke to the chairman of the House Ways and Means Committee about it. I guess it's going to go to the Senate now. Does this mean that we're going to avert a government shutdown?
Most likely, yes. I'm at a 20% chance of a shutdown occurring. And look, you're going to see some language when the Senate comes back next week. Some of the senators aren't really on board with this. They're being jammed up on a provision related to suing over surveillance subpoenas. There's also a provision that the Democrats don't like related to ICE funding. But the easiest thing here is that no party, whether you're a Democrat or Republican, wants to shut down in an election year. And because this passed the House, the Senate most likely is going to just have to swallow their pride and pass this as well. And this would get the funding through the rest of the September 30th of this year. So no more shutdown threats until closer to the election.
I also just wonder for the week to come, Nathan, how much of it is just going to be not just digesting what happened in Davos, but seeing if there's any action to come from it. One of it being that President Trump conceding it would need to be Congress, and he would be asking Congress to put a 10% cap on credit card interest rates. Do you think that this is a body of lawmakers willing to pass such legislation?
No, we're actually at a 40% chance of that passing this year. I apologize, 30%. And the reason being is that there is an unspoken group of lawmakers, and I'm looking at the House Financial Services Committee here, that are allies of Wall Street. And when they see language like we want to cap credit card interest rates at 10%, they do believe their allies that say, look, this is going to have a tremendous impact on credit. They do believe the Jamie Dimons and the Brian Moynahans of the world. And so that's why you're seeing this industry solution. It was reported that Bank of America and Citigroup are planning essentially a card that would cap interest at 10% for 1 year. That's probably going to be enough. But you are going to see folks start to take this idea of affordability and run with it in their own goals. It's been reported the Senate Banking Committee has delayed its crypto work to focus on housing. And that's obviously not what the crypto industry wants to hear. So I think you're going to see in February a little bit more focus on affordability, and then they'll be able to come back and work on things like the crypto bill.
It seems like the U.S. administration has almost completely reversed on Greenland. We were going to offer citizens payouts or potentially bring in the military to take it over. But now there's, I guess, some kind of framework in place that's going to allow us to avoid all of that. Do you have any idea what the framework is?
Well, Bloomberg News is reporting that it's some sort of a combination of some mineral rights plus having access to land to create bases. But I would say is that, President Trump is going to shift away from the international pulpit, if you will, back to domestic starting next week. He's going out to Iowa to have a speech. And there's this idea that affordability is going to be a key theme now through the elections. It's been reported the Republicans are going to have a midterm convention. And let's just say that most Americans vote based on domestic issues, not international issues. And so as we get closer to this election, you're going to see President Trump delve back into domestic policy. And he's probably going to use the bully pulpit in many cases to try and influence policy because we don't see much legislation passing and deregulation takes a long time.
How much stimulus is going to try and pour into this economy, Nathan? Because one way to solve affordability is to try and bring prices down. That's clearly not going to happen. Another way is to just pass out money, which causes its own problems later. But he does seem to want to give stimmy checks out, right?
Yeah, he said earlier, I think it was on Air Force One, he said, look, I don't need Congress to pass out $2,000 stimulus checks. Now, the way it would work in a congressional session is you would pass what is known as a reconciliation bill. You can avoid the filibuster, avoid the Democrats, and go forth and just give out those checks. But I don't think a reconciliation bill can pass this year. The margin in the House is just too thin, and I don't think this idea of a $2,000 check would actually get enough Republican support for it. So President Trump says, look, we don't have to go through Congress. Now, it's unclear where this funds would come from. It would have to be allocated funds appropriated by Congress that he would then be able to change and move around on his own. I'm not exactly sure where you get those funds for. So for right now, we're putting that into the, just keep that in your hip pocket. Keep in mind that potentially could come, but we don't think it's going to come, with at least with a high amount of odds.
Hey, Nathan, thank you very much for that. That is Nathan Dean of Bloomberg Intelligence. And that about does it for us on this Friday. I hope everyone out there is staying safe, staying warm, and hopefully staying off the roads.
Yeah, well, unless you have the proper vehicle.
Oh, yeah, like in chains on your tires.
It can be fun to drive around in.
Oh, God.
Snowstorm. Coming up on Monday, PNC CIO Amanda Agati joins us. TrueCar founder Scott Painter and Baker Hughes CEO Lorenzo Simonelli. This is Bloomberg Open Interest.